Hello, everyone. I'm Susan Saravo with Comerica's marketing team, and I am joined by Bob Buchanan. And Bob is our national practice leader for business transition planning. Long title there, Bob. Welcome.
Thanks, Susan. Great to be back.
Great to have you here. And today we're talking about, does selling your business to a financial buyer make sense for your company? So we're going to get into a lot of detail. But first, the slide that we always start with is how many business owners are thinking about transitioning. Now, you have data about the fact that a lot of business owners over the course of 10 years are going to be transitioning. Tell us more about that.
Yeah, I think the question is the answer is really they're all thinking about transitioning at some point. Even though this slide says seven will never transition, always cracks me up. Every business owner will transition at some point, whether it's in a way that they want to or a way that they don't. But a huge number are going to transition over the next 10 years or over a 10-year period. And I just read a statistic that something like $68 trillion in wealth will be transferred over the next 20 years. And of that, some huge portion is business interests. And when you think about, a large portion of 68 trillion and more than 50% of business owners transitioning in 10 years, that's a big number. And it's a meaningful number, not only in its entirety, but to each of these business owners.
Well, and it's really important to be planning for that transition, whether it's going to happen soon or decades from now. Always have to plan. So we're going to talk more about that coming up. So thank you to all of you who are watching us live here on LinkedIn. And if you have any questions, go ahead and put them in the chat and we will monitor those and get to you a little bit later in our live stream here. All right, Bob, let's start with many ways. There are many ways to transition. So give us an idea of different ways that people can think about transitioning.
Well, transition isn't always a transaction. So a lot of people actually keep their companies and they transition it to a next generation of their family or maybe to employees through management or ownership transfers. And there's a big difference in that. You don't always have to transfer ownership. You can transfer management and transition out of your company. A lot of businesses end up selling, and they sell in different ways. Often to strategic buyers, because strategic buyers can frequently pay higher prices for companies because there's some synergy. But what we've seen over the past several decades is that a lot of business owners are transferring in ways that are more meaningful to them non-financially. And one of those ways might be to a financial buyer, which is really sort of a way of describing private equity groups or private equity-like groups.
So, Bob, the financial requirement is a big consideration. Tell us more about what people have to consider about the financial requirement that's needed.
Yeah, and I think this is the place to start with every business transition, is personal planning and understanding what it is that the owner needs going forward to live the rest of their life in the way that they want to live it. And when you start looking at what that financial requirement is, whether it's $100 million or $1 million, it's important to understand that amount so that going into a transition, you don't end up in a place where you can't live out the rest of your life. Sometimes you can't get there. Someone needs $5 million and their business is only worth 2.5. Well, that means maybe they need to do some planning around changing the way they live their life rather than how much they're going to get. But once you know how much you need, then you look at how much you have. And if there's a gap, the question becomes, can my business fill that gap? And if it can, how does it fill that gap? Is it ongoing cash flow through ownership? Can I build wealth while I continue to own? Or can I sell it and have a liquidity event where I capture the value I've created over time and that fills the gap? But the real point here is that if you're starting to seriously think about transitioning and you haven't done the personal planning, you're starting from the wrong point.
All right, well, that brings us to focusing on a financial buyer. If that's the route that you want to go, having a financial buyer. And you say that kind of along the lines of what you were just talking about, starting with personal financial planning. So tell us more about that.
Right. And with any buyer, you have to start with personal financial planning. So it's not just about understanding how much you need and how much you have, but it's understanding things like, what's the effect on my estate tax bill by selling one way or another? And can I do things ahead of time to reduce that effect? What's the income tax effect? And understanding not just how much you're going to get, but the timing of when you're going to get it is incredibly important. The other things to think about are those non-financial aspects of transitioning. And each transition alternative has different non-financial aspects. So selling to a strategic buyer, for instance, typically the owner is going to walk away from the company either at the closing or very near after. Where selling to a financial buyer might mean that the owner has the opportunity to stay for some period of time, or maybe they have not just the opportunity, but the obligation to stay for some period of time. And so understanding what those things are really drives the decision-making process. And then there are other things like family harmony and legacy and will my company name change and all kinds of things that owners want to think about that come with a cost, but might be more important than the dollars they receive, particularly if they've done that early analysis and they know that they have more than they need already, and everything they get from the company is going to be, gravy on top, that it's just extra, then they really start focusing on those non-financial aspects.
Well, that's true that a lot of business owners have family members that they employ or employees who've been with them for many years. So they do have that as an extra consideration. So thanks for bringing that up, Bob. Okay, next slide, we're going to go to some more considerations. And you lay out 4 specific areas: financial analysis, pre-sale planning, structure, and risk. So let's start with financial analysis.
Yeah, and the financial analysis again goes back to a couple of things. One is that personal planning, and I say this on almost every slide because it's so important, is that the personal financial planning really has to drive the decision-making process. Because if you don't understand what you need and when you need it, then you will end up in a place that you don't have what you need during the time that you need it. The second thing is pre-sale planning. And a lot of this is non-financial planning. It is, what am I going to do the next day? What is my family going to do? How am I going to live the rest of my life and keep myself busy? What are the things I want to accomplish, both financially and non-financially? Do I want to travel? Do I want to participate in volunteer activity and do philanthropic work? Those are the things that are really going to drive your happiness throughout the rest of your life. But there are also lots of financial planning, pre-sale planning things you can do. And if tax planning is important to you, then it's important to start early, because there are a lot of different strategies that can be employed to reduce certain types of taxes. The next thing would be structure. And when you're thinking about structure in selling your business, there's all kinds of ways to sell a company. Typically, when you're doing a sale, buyers want to buy assets and you want to sell stock. And there are a number of reasons for that are risk related as well as financially related. So selling stock provides you with a different tax profile than selling assets typically, but it also provides the buyer with a different tax profile. It allows them to depreciate things in a different way. And so you really want to understand what the structure is going to look like so that you can plan for the taxes. But particularly when you're looking at a sale to a financial buyer, it's important to understand structure, because that structure may take different forms. So most of these sales end up being some large percentage of the company early, upfront. So maybe a private equity group comes in and they say they want to buy 80% of your business. So they're buying 100%, but you're going to roll back 20% of your equity into the new company. And you first have to understand what that means for you financially. What's the 80% valuation? But secondly, what's that 20% look like? And when do you get it? And what do you have to do to earn it? And what are your rights and responsibilities as a shareholder that's now a minority shareholder in a company you used to own? Also, what are your job functions? What's your responsibility in working in the company? So frequently what happens is these private equity groups will buy, let's say 80% of your business, and you roll 20% equity back in. They want to grow the business over the next, say, 5 to 7 years and sell it for some multiple of what they bought it for. And so let's say the first sale is a $100 million valuation. They're hoping to get a $400 or $500 million valuation 5 to 7 years from now, which makes your 20% as valuable or more valuable than the 80% you sold today. But that comes with a catch. There's risk there. Maybe the company has a hard time getting to that place. So you can't guarantee you're going to get that value out of that 20%. Or maybe when it's time to sell in 5 to 7 years, there's not a ready buyer. And so it takes longer. And over that time period that you're still an owner, you're likely going to have to be one of the people leading the charge of building that business to make it larger and more valuable. And frequently, when people are ready to leave, they're ready to leave. And so this is a continuing commitment, and it's a commitment that's different than the commitment you had as a sole owner, because now the commitment is to your majority shareholder, your new bosses. And they're probably going to hold you to a level of accountability that's different than you held yourself to. And so all of these things are incredibly important to think about, especially in a sale to a financial buyer. And then there's risk. And I touched on risk a second ago, but there is greater risk in selling to a financial buyer, just sort of by definition, than there is in most strategic sales. Most strategic sales, you sell 100% of your business and you get all of the cash day one or some near point in time. But with sale to a financial buyer, frequently you're waiting multiple years to cash out the rest of your equity, that rollover piece. And a lot of things can happen during that period. And so if you haven't done the financial planning around what happens if I only get the upfront amount, then you're doing yourself a disservice, because there's real risk in that ongoing piece. And then structure is important as well, because there's risk in structure. Typically, the buyer, the new owner, the financial buyer, private equity group, is going to have some sort of preferred return over time. And they probably have some sort of preferred or some sort of preference in their cash out at the end. And so they're going to need to get all of their money back plus some return before you get paid. And there's risk in that. And those are things that just need to be understood. And I'm not saying that this is a bad way to go. In fact, this is a way that many businesses sell today. And it is incredibly successful for the vast majority of the sellers. But it's not successful if the seller goes into it without understanding the risk, without understanding their responsibilities, and without understanding the economics of the transaction.
Yeah, so it's really a personal decision. And that's why the planning is so important, because it takes time to go through all these and all the considerations to determine what's going to be best for you and your family and everybody. So good points, Bob. All right, let's move on to key takeaways. We covered a lot, especially you covered a lot in that last slide, Bob. So
yeah, I get going on these topics, and sometimes I run a little too long.
No, it's great. You have so much knowledge that it's great to hear you expand on all of that. So, but we do have 3 main points that we want people to walk away with. So let's go for those.
Yeah, and they're the points that I've hit on almost every slide. Understand your needs and understand them early. And not just understand your needs, but understand how different alternatives meet those needs. And those needs aren't all financial. Some of those needs are non-financial. They're emotional and not economic. And understanding and planning for them very early creates higher likelihoods of success later. Because if you wait until someone knocks on the door and you don't really understand what you're getting into, the likelihood that you're going to look back 5 or 10 or 15 years later and regret something that you've done is much higher than if you start early, think through what the alternatives are, understand how each one meets all of the needs that you have and all of the objectives that you have, and then pick the path that is most likely to be successful for you. The other thing here is financial buyers could provide the highest value over time, but there's risk in that value. And so when you're thinking about doing a sale to a financial buyer, particularly a private equity type buyer, it's important to think through who your partner is going to be and whether or not you can reach that end goal of the second payout. A lot of people I've worked with in the past have made it, and a couple haven't, because after year 1 or year 2, they just can't move forward with their new partner as their boss, doing things that they didn't really understand they had to do. And so they walk away from a big chunk of that liquidity that they potentially just leave behind.
Yeah, that could be a big challenge, Bob. If you've been your own boss for years or decades, and then all of a sudden someone else is your boss, that's a big difference in how you operate.
Yeah, and not only is someone else maybe your boss, but maybe your role is different, right?
Hmm.
Before you were making decisions in a way that was down one path, and now the new buyer really wants to grow in a way that you weren't prepared for,
Hmm.
and your role is now sales instead of management. And the
Yeah.
reason it's sales is because you have the relationship with all of your customers, and you can bring in new customers and expand those relationships. And you weren't ready for that. That can
Hmm.
really be a traumatic event in a sale.
Definitely. All right, we're going to take a few questions now from our viewers. The first one is from Iran, and this is a question from a client. The question is, what happens to my management team and employees with these types of transactions?
So that's a great question, and a lot of people when I'm talking to business owners, one of the main concerns they have in any transition is their management team and their employees. Frequently, these people have been with them for years, maybe decades, and have become like family, and they're very concerned about their employment and safety and financial safety going forward. Typically, with this kind of a transaction, the private equity firm that's buying the company, the buyer, the financial buyer, is actually buying the management team. They want that management team to stay in place. And so those management teams are not only generally pretty safe unless they're just not effective, in which case the company wouldn't be interested in buying your business in the first place. But they're generally pretty safe in their positions. In fact, oftentimes the management teams get some sort of equity incentive to help expand that business and grow that business. And so they'll actually participate in that second sale in a way that they might not have otherwise. And so management teams are generally pretty safe. Employees are generally pretty safe as well. Unlike a sale to a strategic buyer, where the buyer probably has a lot of overlap in their employee base and in their management base. Um, and so in those strategic sales, they come in and they cut and they eliminate that duplication. In a financial sale, the buyer really doesn't have that, right? They're buying this business as a standalone. Sometimes they have other businesses in the same industry and they're doing what's called an add-on transaction. And in that case, management teams and employees might be a little bit more at risk, but they still need someone to run the company and they still need people to do the everyday line tasks. So generally speaking, they're fairly safe in this kind of a transaction.
All right. One more question here. This is from James. Question is, how do financial buyers value my business differently than other types of business?
So another good question, and I get this all the time. Um, the way financial buyers value a business is based on a rate of return they need to achieve, and so they can do a financial analysis that looks out into the future and says we're going to grow at X rate, or we're going to assume we're going to grow at this rate, and it's going to take a certain amount of money to get there. We're going to have to make investments, either capital investments or other investments, and the return I need on those investments is X percent. And the reason they do that is that financial buyers are actually big pools of investable cash. And they have people who have provided that money for them. And they have to make some return on that money in order to return it to the investors and make a profit for themselves. And so they have a benchmark. They know the return that they need, and they know the time frame that they're going to invest for, and they'll back into what they have to get, the kind of growth they have to get that return. And so when they're valuing a company, in order to get that return on the growth that they expect, they can pay a certain amount of money. I mean, it's fairly simple math. And so that's different in the way some other companies will value your business, in that other companies may have some synergistic value. And so they're not looking at just your company as a standalone and the growth that it provides them and the return it provides them. They're looking at some additional return that they might get by owning your business or capturing your client base. Maybe they can sell them something else. And so while the process is the same, the thought around that process is different. And so private equity firms just sort of naturally look at businesses in a somewhat different manner than other types of buyers.
Okay. We have another question here from Jonathan. And the question, he says, another question that we hear from clients: what happens if I decide to leave the company after I close a transaction with a financial buyer that requires me to stay? Now, you touched on this, that people may have, I don't know, what would it be called, seller's remorse
Yeah.
once they start working and then think, oh, this is not for me. What happens?
So two things I want to say. One is plan ahead, and when you're thinking about a financial buyer, especially if you're running a process to sell your company, choose your partner before you choose the economics of the transaction. Make sure it's a partner that you want to work with, and that you can work with going forward, because there are going to be some economics that depend on your ability to do that. What you get if you leave early is all dependent on what you negotiate. And so sometimes if you walk away before that secondary transaction, you don't get anything. And sometimes you just have to wait and you'll get some portion. And sometimes you have a right to exit at a certain point in time for some discounted value. So it's important to really think through protecting yourself in the event that you can't stay until the end, until that new owner sells the business, and negotiate a deal, a transaction that provides you an out in the event that you can't stay. Now, again, with that said, don't enter a transaction like this thinking that you're going to leave early, right? These are transactions that they want you to stay. The buyer wants you to be there, and they provide all kinds of incentive for you to be there. That's the whole point of an equity rollover, is that you have skin in the game going forward. And so don't enter a transaction, even though you've protected yourself, with the idea that, well, if I don't like it, I'll just leave. Make sure that you're entering these transactions with your eyes wide open and full knowledge of what will happen, but also with enthusiasm and the idea that you're going to stay and do what needs to be done to get this business to the next level so that the new owner can sell it at a profit that gets them the return they need.
Okay. All right, good stuff, Bob. One more question. This is kind of a basic one, but just simply, what should I look for in a financial buyer? Let's say you're just starting the process and the idea of a financial buyer that appeals to you. What are the basics that you need to look for early?
Yeah, so like I said, make sure it's somebody that you can work with. Make sure they have a vision that you buy into. When they sit down with you and say, "Hey, we'd like to own your company, and here's why we'd like to own your company. Here's what we think we can do with it. Here's how we're going to do it." Make sure those are all things that make sense to you. Because if it doesn't, you'll be in that situation where you're hoping that you protected yourself well enough in the transaction documents because you're going to want to leave early. The other thing to look for is what kind of management do they have? What kind of capital do they have, and are they willing to bring? And what's their growth plan? And what's their historical success rate? Right? If it's a brand new private equity firm, make sure that they have people who are operators who understand your business. Right? If you are a distribution company and the private equity company that's buying you is got expertise only in food service, maybe there's a disconnect. And so when you're thinking about who to go to, make sure that it's someone you're comfortable with and that puts a plan together that you believe is executable with your participation and your willing participation.
Okay. Bob, as we wrap things up here, any final thoughts that you'd like to share?
There are lots of ways to transition out of your business, and financial buyers is just one of many. The final thought I think for everyone who owns a business is, I know you're thinking about it. Everybody's thinking about transition, or you should be thinking about transition. Start talking about it. There's people out there who can help you. There are people out there who've done this, and don't have any agenda. They just want to help you understand what your alternatives are so that you make the best decision. And starting early and combining that planning with personal planning are really the keys. Start now and make sure you're doing personal planning along with it.
All righty. We have a slide that has your information on how to contact you, Bob. So our webpage for you is comerica.com/business transition. And that's a way where you can read Bob's content and learn more about transition planning. And also there's a way where you can contact Bob if you have any questions for him directly. So I wanted to thank everybody for watching our LinkedIn Live. Really appreciate it. And Bob, appreciate you being here again with us and sharing all your expertise and your knowledge.
Happy to do it. Thank you, Susan.
All right. Thanks. Have a great day, everybody.
Bye.